Ladies and gentlemen, please take your seats. It's time for the program to continue. Ladies and gentlemen, the program will continue in just a moment. Please take your seats. True. Ladies and gentlemen, the program is about to continue. Please take your seats. Thank you.
Roll with it. Hi, good morning. Sorry, yes, I project my voice very loud. I'm sorry. Hey, my name is Cameron Lombardo, and I serve as president-elect of the Commercial Investment Division of NOMAR. Hope everybody's been having a great day today. I just wanted to touch on a little bit on what CID does and then announce our newly elected board members. CID builds a prosperous commercial real estate community by providing members and affiliates with information on best practices and access to professional development, connection, and advocacy. This board takes great pride in bringing value to the commercial real estate community through education opportunities, service to the community, broker agent recognition, hosting networking events, and partnering with NOMAR for today's forecast. I would like to take this moment and thank anybody in this room who served currently or has been on the CID Board of Directors before. If you don't mind, please stand for recognition. Thank you. It's with great pleasure for me to announce this year's newly elected board members. Returning board member, William Sadler with Corporate Realty. Beth Christina with Sterling. Jaira Rayford with Rayford Realty NOLA. Ron Patrone with Coldwell Banker Tech. And our chair, Ms. Mignon Richard Diaz with NAI Ladder and Bloom. Board work takes a lot of commitment. These people volunteer their time, put in a lot of effort to make these events great for the rest of us. So please, if you aren't a CID member, join. We love helping the community. We love helping agents make the right decisions when it comes to advising their clients, and we like to have fun. So thank you all and enjoy the rest of the day.
I'm from Louisiana State University. I teach. So y'all sit down, shut up, get off your damn phones. Thank you very much. I am actually Brian Andrews, and if there's any presentation here today that is inaccurate, it's they asked for a current picture. And yeah, the recent ones don't look good. I am privileged to moderate a panel discussion today on the challenges of underwriting, the challenge of underwriting today. And with me today, we're going to have the panel discussion. Starting off on my left, your right, we've got, I believe, John Zollinger, EVP and Chief Banking Officer from Home Bank. We also have with us today Hamilton, there you go, Hamilton Blanton, Senior Vice President, Regional Commercial Market Manager from Bank Plus. And then we also have Meghan Donelon from New Orleans Market President from Red River Bank. So that's your panel today. That's us. I have a slight warning for the photographer. Is the photographer here? You're there? Okay. You're going to want a close-up on this. I did ask earlier if, what happens if I do something wrong, and they said, we've got the hook to pull you off. And I said, well, okay, can I, is there a roving mic? But the smart thing was I asked for the roving mic first, and then I asked that question. I am with Louisiana State University. You can tell from the jacket. You can tell from the tie. And you can tell from and you can tell from this. Senior instructor fired for, anyway. We are pleased, all of us are very pleased to be here today. And we'd like to see, can you all put up the slides with all the bad news? Oh, we didn't do any slides with bad news. So just in your head, imagine bad stuff increasing, good stuff decreasing, interest rates moving to the right. And that's really all you need to know. What do we want to do here today? Well, one thing I want to do is acknowledge the lenders who are here, our lending sponsors. The presenting sponsor, Gulf Coast Bank and Trust, thank you for your support. The break sponsor, Home Bank. Our table sponsors out there, B1 Bank, Bank Plus, Credit Human, Federal Credit Union. I believe they paid 25% more for their table to make up for some stuff. First Horizon, Metairie Bank, Red River Bank, and Standard Mortgage. Thank you, lenders, for supporting this event. To lay the table a little bit about what we want to try to do with our time with you today is, well, the CID, No More CID, has a list of 4 things that they really want us to focus on. The first being to provide high-level experience on relevant market conditions to realtors and to our industry partners. That's what we want to do. We don't want to just be up here and talk at you. We want this to be a conversation, and our goal today is for you to take the information from this panel and go out and make money with it. I mean, really, that's what we want to do. That's what we want to do. You know what's fun? I just saw Wilson out there. He was my student. Hey, dude. I'm seeing all my students out here. It's been fun, my recovering students. All right. We have, still recovering, may never. We're going to talk about a couple of issues today. Now, one thing I do want to make sure we understand, that we have 3 different financial institutions here, others represented out there. Some of the comments that you hear are going to be about the market. So if John says something about the market that he observes, that's about everybody, not necessarily just about Home Bank. So keep that in mind. But what we're trying to do is give you information that you can go out and make some money with it. So let's set the table here. How y'all are. Let's start at 30,000 feet, and let's go from John this direction. Overall, how are the lenders feeling about commercial real estate and residential?
I would say we're fairly positive. I think we're going to see a big price decline overall, because we would expect that with higher insurance costs, higher interest rates, all of those kind of things happening in the environment. I don't know that we've really seen that manifest itself in the market just yet. I feel like there's a fairly decent disconnect between sellers and buyers' expectations at this point. And so until that kind of reconciles itself over time in the market, I think we're seeing less transactions because of that. There's a myriad of reasons for why that's going on.
So are lenders still in the market, do you think?
From what I've been able to tell, we're still all interested in lending money to good, creditworthy borrowers.
Okay, awesome. Meghan, tell us about your view. You're the market president for this area. What are you seeing out there for lenders in this market?
We're still seeing deals. Like John said, we're not really seeing the impacts of interest rate increases and increased costs impacting appraised values yet. I think we're starting to finally see that, but it took longer than you would expect. So we are going to see decreases in values probably in the next 6 to 12 months, and it's going to impact supply, and and probably impact how we all behave, but we're still lending money. We're still excited to lend money. We have dollars to lend, and we're open for business, so
Okay,
still
awesome.
positive.
Awesome, thank you. Hamilton, what are you seeing out there in the marketplace?
Yeah, I think to a certain degree it's helpful to kind of set the table from where we were 18 months ago to where we are today. And I think to echo what both y'all are saying, I mean, the deal flow's there. I think it's just reconciliation between borrowers and where financial institutions are in terms of wanting to lend capital. You know, the metrics have changed. And I think the more we can articulate that to clients and say, look, we want to get deals done, but they have to look and feel differently than the terms that you were expecting 18 months ago. I think we're all open for business. I think times are never been truer where relationships matter. You know, I'm seeing more and more deals from folks that have been at other financial institutions for a while, and they're coming to us because I think we're all similarly posturing ourselves, and they want to mark to market. Well, if I heard something at one bank, am I going to hear that somewhere else? And I think setting realistic expectations, because I think to John's point and to Meghan's, that we're probably closer to the next bottom than we are to the top, and I think getting sellers and buyers to kind of come to equilibrium on that piece is kind of like, I think, what is going to be the challenge for the next 12 months.
Thank you. That's one of the big goals that we wanted to have for you today, is that things have changed. The deal that you got done 12 months ago, the players may still say, yeah, we're in the market, but the terms may be different. They may be very different. So what has changed with the banks? Last week, a report came out from the FDIC's Office of the Inspector General, where they reviewed the failure of Silicon Valley Bank. And you might have heard Silicon Valley Bank failed like quick. And it was one of those things where rumors got out in the market. There was a bank run, and then the institution was shut down. The process took about that long. So right now, what I'm seeing from our research at LSU and other academics, what we're seeing is that the banks are in the market. They have liquidity. They have decent equity. They're okay. The problem that they've got right now is, what if the market freaks out again? Now you can tell I'm not an academic because I just use the economic term freak out. They're concerned about freakouts with the marketplace, where people start pulling their market out, their money out of the banks. So can we talk about your liquidity issues a little bit? I'm going to start with Meghan, then Hamilton, then John. What are your thoughts right now, Meghan, as far as your liquidity issues? I'm going to start with Hamilton. Psych.
I think the word liquidity issues, I think, aren't necessarily apt for the folks that are on this stage and really for our region. I think stepping back and talking about the Silicon Valley Bank failure and some other bank failures that we saw, I think there was this concern about whether or not those failures were systemic and they were going to be rampant throughout the entire country. And I think as we step back and we sort of read the tea leaves, and we're going to do our case studies down the road, we'll realize that they were really more idiosyncratic. They were specific. There were types of depository bases, types of lending that those institutions did. And I'll say this for myself and for Bank Plus, I've never been happier that our depository base was Louisiana, Mississippi, and Alabama. Because I promise you, those folks didn't make a run to the bank. If anything, what we've seen over the last number of quarters, we've actually grown our depository base. So we're in a different circumstance than some of the coastal banks, some of the ones that were deposit heavy from the private equity firms and some of the other niche lending that was done. So I think when you talk about partnering, we partner on a lot of deals. We see a lot of deal flow. The run on banks and the runs on deposits isn't really what we've been confronted with. I think where we are in the cycle, and this is kind of from our prior institution, what we dealt with was 80% of the deals that went bad at the last cycle were made in the preceding 9 to 6 months. And I think we all see that there's some headwinds challenging us, so we're just getting conservative. And we don't want to make those bad loans because we're in a thin margin business, and it takes a lot of loans to get back writing off tens of millions of dollars on loans that we make bad. So just trying to make sure that we've got enough equity in, we're underwriting properly. I think liquidity is not the issue. There's a lot of peer reviews about all of our peer banks, and I think profitability, loan to deposit ratio, we're all kind of in a similar spot, and we're still open for business. We're just prioritizing and trying to underwrite them to where we know we don't have a non-performing loan in the next 12 months.
part of the thought process, I think, is we've got plenty of liquidity, which is to say we've got lots of cash and near cash available to make loans and to pay our debts as they come due and so forth. But the thought process is right now, we are not our own masters. We are chartered institutions, and we have regulators who try to tell us, you know, hey, we want to make sure that you're doing okay. Make sure you've got enough liquidity. So some of the issues that I'm hearing from banks is, yeah, we've got plenty of liquidity. We've got more than we had last time or this time last year. But our concern is, how much of that liquidity do we lend out? We're still in the market. John, what are your thoughts on the banks right now? They've got their cash. Are they being more judicious about where that cash goes?
Yeah, so prior to SVP's failure, they actually made me a liar. I had always said that banks only fail because of bad loans. And that's generally been true throughout human history until that point. They failed because they were too concentrated in one area. So, you know, diversification of portfolio, both on deposit side and the loan side, are really important. So, you know, we're using our experiences, like Hamilton said earlier, to know that if the cycle is going to turn down, and if we make bad loans, that's how we fail. We don't want to do that, and so we're trying to make sure that credit is always the most important thing to a bank. Because our margins are very thin, we don't have a lot of capital. You know, at the most, we might have 9–10% capital, so it doesn't take much for us to get into negative territory to do that. So, you know, credit quality is probably the most important part. And then, you know, as liquidity has become more expensive, we're using our bullets a little bit more judiciously. We're using our capital more judiciously, and we want to use it with probably people that we know that we can expand a relationship with or already have a very strong relationship with. And so those are the clients that we're focusing on the most. That's not to say that we won't entertain new clients into the bank, but it'd have to, you know, make sure it makes sense for both parties.
Sure. Well, and let's talk about cash as inventory for you guys and for the other lenders out there. Cash is their inventory. And how much inventory did they have last year? How much inventory do they have now? What was the cost of their inventory last year? What's the cost of their inventory now? A year ago, when I was talking to bankers, they were saying, man, we got so much liquidity. We have so much liquidity. And I know some of my students will remember the rates that I used to say that banks paid, 0.01 bite me. That was the rate that you got because there was so much liquidity. But what has happened now with the levels of your cash inventory and the cost of your inventory? How much deposits do you have, and what are you paying for deposits? Do you want to go for that one?
Sure. Well, my bank's a little different. I'm fortunate that our loan to deposit ratio is extremely low. But having said that, I think we're all in the position because of the liquidity crunch that's happening, you know, across the country, across the globe, really. We're not, and because of the, you know, credit crunch that's starting to happen too, we're not necessarily looking to lend our dollars to massive projects without depository relationships as well. We used to all, you know, shoot for the moon to attract great new borrowers and maybe not necessarily mandate other lines of business, but we really, you know, we're all kind of more relationship focused because we want to keep our loan to deposit ratios in check.
So I think the banks are suggesting that they're not in it just for the transaction that is a loan, but they also want your deposits. Is it fair to say then that a loan presentation to you that also includes moving deposits to you is looked at favorably, all other things being equal, but the deal that does not bring deposits, you're going to look at the first one more favorably than the second one?
I think that's fair.
And I think that's absolutely the truth. Do you have any other color on that?
No, I mean, not only to help loan to deposit ratio and keep things somewhat copacetic, I mean, there's also regulatory treatment. So if you're trying to educate folks in terms of why deposits are important, the cost of capital, the way that we allocate capital for loan loss provisioning and in our CCAR stress testing is all predicated on what share of wallet we have with our individual borrowers. So not only is it important from a profitability perspective, but from a regulatory perspective, it helps us manage our balance sheet.
So, go ahead, John,
Brian,
please.
I think another point in that is that it has a lot to do with margin, right? So if I have to pay you 5% for your deposits, you know, then and you want to borrow money, where do I have to lend money to you there?
Sure.
So, it's about the whole relationship and the whole margin thing.
And above and beyond that too, just thinking about structurally we're talking about what deals need to look like. The deals need to have more equity. Our sponsors, our developers, our borrowers need to have more cash, not only in the deal, but on the sideline. And as lenders, if we're going to be sticking our neck out when we know the lending environment's contracted, I think as a lender, I want to have those depositories that I know that are sitting on the side that help us make this deal happen. They should be sitting with Bank Plus and Home Bank, not sitting at Chase or Wells Fargo, who's not doing these projects. So I know there was flight to quality with some folks that thought, all right, well, if I'm pulling out of Silicon Valley, all the largest banks were the net beneficiaries of all of these fleeing deposits. I don't think we were as impacted by some of the other banks in some of these major metropolitan areas. But if we're the ones, I mean, I think the last statistic I heard that somewhere between 75 and 80% of all the commercial real estate deals that got done in the non-permanent market, non-CMBS market, were done by regional and small banks. They weren't getting done by, and I say that bifurcated, where it's the medium and small real estate deals were getting done by folks like us.
So if you're trying to
not by the big banks.
maximize the return on your cash, sending it to New York is not really benefiting our local economy, because the New York banks are not lending in New Orleans. We are.
They're not, yeah. They're not doing the $5 million multifamily projects. We are.
So the banks are still in the market. Things have changed from a year ago. The cost of deposits have gone up, and as a result, interest rates have gone up. The deal that was done last year is different from the deal that's going to be done this year and going into the future. So let's talk about general underwriting challenges that we've got. And Hamilton, I'm going to throw this one to you. Some of the thoughts of there is rumor that insurance costs have gone up. There is rumor that we're having a little trouble with the defensive line. Rumors. Tell us how that presents a challenge for you with the general CRE underwriting guidelines.
Yeah, I think what we saw through the last 18 months was a very optimistic view on the macroeconomic picture. And it allowed a lot of banks to make some pretty healthy assumptions in terms of pass-throughs of rising rental rates, managing some what the Fed at the time called as transitory costs that I think fast forward to where we are today, some of those rent and revenue increases haven't been able to materialize, and inflation's been more persistent than I think we all thought it could have been. So everyone's dollar's gotten worth a little bit less, and then the way that the Fed's trying to curtail that is through raising interest rates. So the calculus in terms of where cap rates are moving, the NOI that we underwrite to, the debt service coverage that we want. You know, it's funny just thinking back over the last 20 years of probably our respective careers. It was almost this odd fallacy of stress testing deals through rising rates through a 200 basis point movement. Well, we're way through that in the last 18 months.
Yeah.
And you know, I know everyone's reading the same news that we all are, is that you've got this, you know, a lot of these deals that happen in the middle and lower end of the real estate market are typically of 5-year tenor. And depending on where you did it, I mean, I was talking to a friend of mine who's at Morgan Stanley, and it's the corporates, the folks that had access to long-term capital, they knew rates were going to stay as forever when they saw the underpinnings of inflation, and they were able to go do 20, 30-year bonds. That's not our borrower, you know. And so we're going to all have. We talk about relationships outside of just the depository piece. There are going to be cracks in the foundation. I think the biggest thing I can tell you all is that as we're coming up on renewals and maturities, the expectation on debt service coverage, the ability to right-size capital, being able to articulate realistic costs is all going to be an important part of that calculus. But we realize, and it doesn't matter if it's us, and I talked to someone else up in New York about this morning, is that no one wants to be in the business of taking back the real estate. But the earlier that you can communicate with your lenders about where there's going to be some holes, the easier it is for us to work with you.
Sure.
So, I mean, I think that's just a resounding theme that I think hopefully folks, like, we don't want to own the property. We don't want to own your business. No one can manage it better than you can.
Well, let's go to some of those underwriting terms, what they were maybe last year and what we're looking at today. Certainly, the rise of, and isn't it something where you're having cocktails with somebody and you say, you know, my insurance costs went up 100%, and everybody else is going, oh, you are so lucky. Mine went up 1,800%. So we'll talk about the impact on NOI with that in just a second. But given that, you know, we saw everything that the prior economists came up with, we saw all the uncertainty that's happening. And the thing about banks is that they cannot take on the risk. They cannot take on the risk. If your deal does awesome, are you going to share some of that excess with the lender? And yeah, I know I promised you an 8% rate, but here's a couple of extra bucks. Go buy something pretty. No, you get the 8% interest. That's all you get. Banks cannot afford to take a loss. The profit margins are too thin. And when things are disruptive, as they are now, they've got to get more conservative with their underwriting. And I suspect that that's what's happened. So your underwriting, and we'll get into different kinds of lending and different property types in a moment, but as far as like loan to value, cash in, you know, those kinds of underwriting terms, what are you guys coming up with? Megan, do you want to grab that one?
Sure. And just to touch on insurance a bit more, you know, and kind of to echo what Hamilton said, it's a huge issue, obviously, for all of us. And I think the best way we can all combat it is to have, you know, lead time conversations surrounding renewals 6 months in advance. You know, I think we're all used to a world where, you know, a month or two before a renewal is set to mature, you're just starting to have the conversation with your banker, but you need to think way ahead there, because it is a crisis and it's definitely impacting NOI as well as interest rates. Because to Hamilton's point, if, you know, we originated something with just 20% equity in the high threes 5 years ago, you know, we were only stress testing at 200 basis points. That's not reality today. So we're going to have that challenge coupled with these insurance premium increases. In some cases, our clients can't even get wind and hail, you know, and they're asking us to get creative. And I think all three of our banks are willing to do that, but with appropriate lead time. So
Yeah.
the conversations need to start earlier.
Well, if last year or in times past you were willing to make a loan on an apartment complex at 75, 80% LTV, what are you looking at now?
Well, it's a backwards formula, right? So you have NOI, and if NOI is going down, then you basically can't lend as much money on the property to make it to where it can cash flow. So there needs to be more equity. And generally that comes through the form of cash. So, I mean, I almost hate to say it's just a mathematical formula of how it works.
Sure, but
but what we are seeing is that, you know, in order to get to that number of 125 or 130 debt service coverage ratio, you're going to have to finance less to be able to do that, which means higher equity. So if you're coming into a deal, you know, there's two ways to fix that: either lower the price or lower the amount that you finance, which means more equity. So what we are seeing is probably 30-40% equity to get a deal down now, so that it does still have that comfortable margin in the cash flow.
So a deal done a year ago at 75, 80% LTV is going to be more conservative now, lower loan to values, and higher cash requirements going in.
I wouldn't say it's going to be more conservative. It's just a factor of the numbers. If your insurance costs went up and your interest costs went up, then your NOI goes down. And so,
Right, well, we're going to talk
yeah.
about debt coverage in just a second, but in general, LTVs are going down, which is perceived to be conservative.
because they're a factor of cash flow.
Okay.
They go together.
Okay. Wilson, do you want to take this one? That you size a loan based on the lower of DCR, LTV, and other. Okay, anyway. Well, then let's talk about debt coverage ratios. We're trying to get our NOI to cover debt service at a comfortable margin. We used to say, gosh, I remember when I did Walgreens originations, the debt coverage ratio was 1.003, apartments 120, and so forth. And that might have been, for apartments and other things, you might have had a certain debt coverage ratio. What can borrowers expect now, do you think?
I'll share what it's not for secret signs. I mean, I think out of the gate, something new, we're looking at a 1.4 coverage and above. I think anything beneath that has to have some pretty extenuating circumstances. And then that just dovetails into, what we were all, I think was pretty prevalent in the market, a 1.2 coverage or 1.1 coverage, wasn't off the table all that long ago. And so, I think it'd be hard pressed. I don't know if folks are looking at it any tighter than that. And, usually once one person gets conservative, all the local banks and regional banks start moving in the same direction. So,
sure.
And ultimately, in terms of risk management, it's real estate's not monolithic, and I'm talking to a bunch of people in this room that all know it. So, retail's not the same as office versus multifamily versus affordable versus residential. I think there's certain asset classes, whether it be us or Wall Street, we all like something different. And I think our crystal ball is not as good as anybody else's, but
yeah.
I think cash flow is exceptionally important, knowing that you're probably going to have to continue to stress test it. And just thinking through some of these issues that have also occurred is that a lot of deals that got done, there was always this permanent market. There was this securitization market that was an outlet valve for a lot of deals that got put on the regional and community banks' books. That's, if interest rates are higher for longer, we're now lenders for longer. A lot of stuff that wasn't supposed to pay off and wasn't supposed to be on our books come this time of year, we're all sitting with. And, hopefully we all underwrote it okay because we got enough equity on the front end, but it still doesn't qualify for what the CMBS market is willing to digest right now. Deal flow's down, and their goalposts have moved as well. So, I think we're probably going to need to work with lenders. I'm not saying on renewals that necessarily debt service coverage has to be at a 1.4 time, but new stuff's got to.
Yeah. I did speak to some permanent lenders, and I'm so used to hearing borrowers talk about cash out refis, right? Everybody loves a cash out refi. You don't have to sell the property, you just refi and pull cash out. Start thinking cash in refis. I had never heard of such a thing, but I'm hearing it from so many people. And again, we're just trying to manage the expectations of our customers. Because if the real estate agents out there are working with the customer saying, yeah, well, I got these terms 18 months ago, I'm assuming they're the same. The property appraised 18 months ago, and I'm assuming that it's staying the same. What do you think? You wasting your time with that customer? Anybody in the room get paid for deals that you almost closed? And that's what we're trying to do, is help you manage the expectations of your clients based on what the lenders will and will not do. Because without them, there's no closing. Without a closing, you don't get paid. That's what we're trying to talk about here. So yeah, cash in refis, that's pretty tough.
I would just also add that there isn't like a one size fits all for DSC ratios or how we look at them. If you're buying a property with a credit tenant that's got 10 years left on its lease, triple net, you're going to get more favorable terms than a speculative multifamily project or hospitality project or any other asset class, really. But
sure, and I'm pretty sure that the commercial agents have taken the courses where they know that historically apartments had the highest LTV, the lowest debt coverage ratio. Retail office had theirs. Hotel was, forget about it. Hotel had the highest debt coverage and the lowest loan to value. So yeah, they're different. And even within apartments, there's different categories, even
Sure,
within
now,
all these
now
things.
office is kind of on the outs because of everything that's going on with COVID and the changes in office space.
Yeah, and we'll talk about that in just a second. So that's great. Well, let's talk about the kinds of loans that we're doing, and we're going to talk about new construction, acquisitions, and renewals. We're going to start talking about new construction, and you know, is there money out there for new construction? Because some of you folks may be working with a client to take down land and do pre-leasing and things like that. What's going on with money for new construction, Megan? What do you think?
Sure. Well, I think, a hot asset class right now is industrial. We're seeing the Amazons of the world needing more distribution centers. That's ideal when Amazon inks a long-term lease. You can definitely rely on that. But just in general, my bank, we're building a branch on Veterans right now, and we're using Landis Construction, and we were definitely surprised by the cost, but it's all traceable, and it kind of, you can blame inflation for a lot of it, you can blame the pandemic, but they shared with me that their overall labor costs have increased 10%. Specialty items like generators, the lead time is really long. And a lot of that, has to do, it's pandemic and inflation related, and they have to pass those costs on to their customers, who unfortunately are all of us. But, I don't think any of us are closed for business for new construction, but, underwriting, again, it's tighter. It's, so you're not just accounting for insurance and increase in interest rates, you have to account for labor costs and inflation.
Delays.
And
delays. Well, what are the keys for them bringing their customers to you for a positive look for a construction deal? What do you think?
I'll say before we even get into that, I think one thing that's fundamental that I think is starting, there's this massive delta now from what you just described between existing assets and new construction. And I think if you're trying to educate borrowers and investors, they're overpaying by and large if they're trying to do new construction. The replacement cost value are way higher than you can buy a vacant piece of property. And that's universal between office, multifamily, across the board. And I think you're seeing I think a lot of our folks internally, the smart money, just saying that if you're doing the calculus on your ROI, it's way cheaper to buy, even if it's a 1970s vintage multifamily deal, it's way cheaper, and the cost of capital is cheaper, the cost of execution is cheaper, and the cash flow generation is way sooner. So I think it has to be a really compelling story to want to do new construction, given where we are in the environment. And I think we're way closer to the top than we are to the bottom. I think John and I were talking about this earlier. Like, cash is king, and I think if you've got some well-heeled borrowers that are sitting on a lot of cash, there's going to be an opportunity to cherry pick some really nice assets at a discount rather than try to strap yourself for doing new construction.
Yeah, I agree. I'm talking to a developer last week who does a lot of Dollar General, and he was saying that it makes almost no sense to build a new one because of all the costs associated with it. He's looking at maybe finding some ones that are maybe not distressed, but could be turned around. Doing turnarounds is much more economical use of his capital than do that. And, I think I told you this earlier in the green room, Brian. I mean, the best thing you can do as a real estate developer is your ability to walk away, because it could be the best deal you ever made. Stretching at this point in the cycle doesn't make a lot of sense. And sticking to that box that you have always stuck to, and it's been good for you, and you've been able to make money, and you know that those are the way you're successful as a real estate investor and a developer, you need to stick to that. You cannot rationalize your way into why this one's different because you haven't done a deal in 12 months or the market's not right or whatever. The market's not right, it's not right. You need to move on. And that's a hard thing for people who want to do deals and develop and invest and do that. Sitting on the sidelines and waiting is not comfortable. but sometimes it's really the best thing that you can do.
It's better to make nothing than to lose a lot. I get you. And, you know, in our classes, we try to tell the students, you know, think about what has to happen for this deal to be successful and what could go wrong. I think with new construction right now, what has to happen is a pretty narrow alley, and what could go wrong is pretty wide. Labor issues, that's what you talked about earlier. Labor issues could happen. Further interest rate increases could happen. Scarcity of materials could be an issue. And with all of these things, you guys need a sponsor with a lot of cash, not necessarily in the deal, although it's going to require that, but also a lot of cash in their pocket in case stuff goes wrong with construction.
But you start talking about issues with permitting. I mean, you know, a lot of jurisdictions are not, I mean, they're suffering the same labor problems everybody else is. They don't have good people to process all of the stuff that it takes to get a deal to the finish line so that you can even start construction. We've seen great delays in that part of the process, which means more interest cost, more cost, more cost. And so how do you absorb that in a project? It's really difficult.
Go ahead,
But
Meghan.
also just specific to construction, new construction projects, we used to all kind of be comfortable with 5% contingency built within those budgets. I'd say it's more like 10 now. And also expect change orders.
Yeah. We used to say the rule of thumb was 5% contingency on new construction and 10% on redos. Now it's 10% or more, and it's not that the banks are being difficult. Your experience is that you're seeing that avenue of things that can go wrong with timing, interest rate, labor, etc. Yeah. So that's what they can expect. If they're working on a construction deal with one of their clients, that client has to put in a lot of cash, has a lot of cash on the side, and you are going to be looking at all the things that could go wrong, not in a, well, a meteor could hit it kind of way, but you're looking at it, hey, we're not participating in the upside. We're trying to get our money back in our interest. So if something goes wrong, sponsor, you got to help us out.
And if something goes wrong for us, something's already going wrong for you all. So,
Yeah, absolutely, absolutely. I'd like to move on to acquisitions, because we talked about construction, and it's funny, I'm thinking here about in Baton Rouge, one of the biggest construction projects that we've had recently was the Amazon warehouse. And do you know what they tore down to make room for the Amazon warehouse? Cortana Mall. Sometimes the jokes write themselves when that happened. So let's talk about acquisitions, and this is going to be really thrown out to everybody. I mean, we said that replacement costs are much higher right now, so it may be okay to do an acquisition for them and their clients. What's going on with acquisitions? How are you guys looking at acquisition loans? Understanding that it's like, well, talking about apartment complex, talking about an office building, what are you talking about? In general, and then particularly we'll talk more about that. John, do you want to start with that? We'll move this way.
Yeah, I think it comes down to the value that you're able to buy it at. You know, are you getting it at the right price? Because there's only one lever you can pull in real estate to make a deal work or not, and that's price. And so I think you're going to have to see
You could also talk the agent down on their fee.
No. Boo. Nobody should work for free.
That's right.
So
Hey, you don't like it, you talk to the people where I work, University of Texas, you tell them, no, never mind. Go ahead.
So, you know, price is really the prime driver of, are you able to make a deal work? You know, the economics of a deal are very important. There's other issues associated with it that are just as important. Can you execute on the project? Do you have experience to manage? All those things are really important. Yeah. But at the end of the day, it's about the economics of the deal. Does it work? And is there enough wiggle room in there for you to withstand plan B or plan C or plan D, because plan A never happens the way it's supposed to. And can you kind of get through that?
Yeah. Plan A, y'all, you remember that deal you did where everything worked just perfectly? Yeah, me either. So we have to have B and C and D and so forth. What do you think on new acquisitions? What are the big levers for you, knowing that they make money by helping someone sell or buy property? That can't happen without a loan. So what do they need to know about acquisitions?
It's, kind of the same theme we've been discussing. It's cash in. You can expect the bank to want more cash in a deal because we aren't testing to 1-to-5 necessarily anymore. Those ratios have increased. So regardless of asset class, again, if it's, a 10-year Amazon lease, that's different, but that's not most of the deals we look at. So you can expect, more stringent debt service coverage requirements, sometimes interest reserves, which in the beginning of my career I wasn't implementing very often, but that's more frequent and common now. And just, liquidity on the sideline, like you referenced before.
Yeah. My students get kind of tired of me saying, 3.25% prime rate. When I was at LSU, it went to 21. And and it did. Average for 1980 was 18%. And the response, do you want to remember the response, Wilson? Yeah, okay, boomer. So we didn't talk about that much. So, acquisitions, you're looking at them, depends upon property type, and what we can expect is more cash in than we were saying a year ago. Hamilton, what do you guys think?
Yeah, I think fundamentally acquisitions are a lot easier. think about it. The path to profitability is a lot quicker. It's a lot easier for bankers to underwrite when I've got existing and pre-existing cash flows. It's easier to kind of model out and synthesize and stress test. And fundamentally, I think that's where you've seen a lot of pockets activity, at least I know what I've seen at our financial institution, is multi-generational assets where folks were trying to time the top of the market. All of a sudden, they've got a renewal on their loan that their interest costs have tripled. Their insurance costs have doubled, tripled, quadrupled, and their mailbox money shrunk.
Yeah.
And they're like, you know what? I know this isn't maybe peak valuations, but I'll take 11 million instead of 13 just to take money off the table. And that's where you've seen some valuations equilibrate and some opportunities. A lot of these property also, especially in this market where there's not a lot of freestanding land, you can't do a lot of new construction, there's a lot of vintage properties out there that have a ton of deferred maintenance and deferred CapEx. So I think that's where the underpinnings of some valuations, you can get some folks that are looking to sell, and a lot of the buyers that were not indigenous and local to this market have gone away. So a lot of the deals that are trading in this market are folks that are from this area, understand it, know the nuances. Like New Orleans and Louisiana is so nuanced, block to block, zip code to zip code, and it's tough for folks in New York and California to discern those nuances and those differences. So I think that's where some opportunities are. I think we've seen some deal flow there, and I'd much rather underwrite proven cash flow and sensitivity test that and stress test that than trying to do pro forma on new construction and other deals.
I agree that I agree it's totally easier, and I agree that there's a lot of potential in the market and deferred maintenance, along the major highways we all know. I'm also seeing a lot of local borrowers go out of state though, and I don't know if that's related back to insurance costs and just kind of the state of the South, but we're looking at deals in Greenville, we're looking at deals in Tampa, Fort Worth, kind of hotter, Nashville, hotter markets, local borrowers going to hotter markets just to trend them.
I think that's driven by the political environment. Our city feels like it's closed for business sometimes when it comes to providing a stable political legislative environment that would attract capital. Capital has no borders. And so it can go to Nashville. And I think people in the city our city leaders don't always quite realize that. They think that this is a great place, and it is a great place. It's a wonderful place. But, attracting investment and encouraging it is not always on top of their mind.
Understand. And I know that some of the borrowers that I used to work with as a commercial mortgage broker, they would have most of their portfolios here, but yeah, they wanted to spread the wealth. Texas, Alabama, Florida, all the SEC states. So yeah, they were spreading out. And yeah, there are some political issues. You work for a state-funded university. Don't say anything else. Okay? Well, how about you guys? Just a show of hands or whatever like that. What are you guys looking at? Are you looking at more acquisitions or new construction? How about new construction? Who's looking at new construction right now? Yeah. How about acquisitions? Yeah, that's what you're looking at. So please listen to what they're saying about you don't get paid until they fund the loan. So yeah, please hear what they're saying about what they're looking for.
No pressure there. Thanks.
No pressure. Yes. Unless Z funds the loan, you can't afford your tickets to the Saints games anymore. So may not be an issue. Okay, well then let's talk about renewals. And why do you guys care about renewals? Because I guess we all know that you can't just live with brokerage income, you're also doing leasing income. And if the customer cannot get their loan renewed, that may be a negative issue for your leasing income. So let's talk about...
Well, I think it could be a positive thing because then they might want to sell.
Positive.
Well, if they can.
Over there. Yeah.
If they can. But let's talk about renewals. What's going on? Let's go. Meghan, can you talk about what you're seeing out there right now with renewals?
So I am in a bit of a unique position because I've been at my current bank for 2 years. So I'm responsible for our de novo expansion in this market. But thinking logically and what we all do, we kind of touched on it earlier. The way we behaved as borrowers and bankers is, renewals historically, 99 times out of 100 are pretty easy, and only require a month or two of negotiation to kind of get to the finish line. We're in a very different environment now.
Yeah.
500 basis points different likely than origination, and insurance issues, and just rising costs associated with inflation, utilities, everything. So everything is a lot more expensive than it was at origination, no matter who you are, where you work. And so, again, those conversations need to start happening 6 months in advance so that you can work through the insurance issues, so that you can take a look at where cash flow is now and where it might be 50 basis points from now and all of that good stuff.
I'm hearing that from every single banker, so please let's hear that. We can't go in a week before renewal. We can't go in a month. It's 6 months at a minimum before renewal to find out if the bank even wants to do it. Okay, and I'm not suggesting these three are in the situation, but some banks might have made the decision, you know what, our real estate bucket is full. We kind of don't, we thought we were going to have this new construction or these turnarounds moved out to the permanent market, but they're just not working right now. They're not moving out. So our commercial real estate bucket is full. So without saying your particular institutions, is it reasonable to say that a bank might react, hey, we're not going to renew, we need you to find a new home?
It does happen. Especially bigger, more regional banks would be in a position sometimes where they just blanket say, we're not doing this. And I think our institutions are a little bit different in that, we understand that we work in our community and we need to be continually invested in our community. But risk is risk. And so if we see an elevated risk in a deal, then we are going to try and mitigate that risk or push it away. It's a natural reaction to what banks do. So I think it is great advice to start early. Understand where your cash flow is. I think one thing that hasn't really been brought out yet is the fact that, inflation has happened a lot, but it hasn't happened at the top line as much as it's happened in the expenses. A lot of people signed 5-year leases that had built-in escalation clauses in it that weren't tied to CPI, so you're not getting full benefit of high inflation in these most recent periods. You're kind of locked into the income stream, and you can't affect that end of the line as much as what's happening to you on the bottom end. And so you're getting squeezed pretty hard, and there's only so much, we only accept one form of payment. We accept cash. And so you need to have the cash flow to be able to do that. You either have cash on the sidelines to make your payments, or you need to have cash flow to make your payments. And so that's what we're most focused on, because that's how we get repaid.
So the big bottom line there is renewals. Your customers need your help to look at rent rolls and say, hey, how are we structured? If it's apartments, do you have, or anything, more than 20% of the lease is rolling? We got to explain that. Are we at market? Are we above market and going to adjust down? Are we below market and going to adjust up? All these things are questions that you guys are going to ask. So these are things that, to add value with your customers, they're going to need. They're going to need that. And what the banks are begging for is lead time. And I think if you encourage your borrowers to get that minimum of 6 months, you're serving your customers well. Do y'all agree with that? Awesome. I want to throw it out there. I've got an hour left, so I've got people backstage, get the longer hook. I do want to throw some questions out to you. I do have some things to say from the permanent market, but how are we doing? Are the banks addressing your concerns right now? Anybody have something they want to say? Valbridge is going to tell you what cap rates are going to be 10 years out. They'll do that in just a moment. But anybody else have a question for Ask a Banker? I heard, what about the high insurance? Yeah. What conversations are you guys having with your customers about the availability of, the pricing of, the level of deductibles and things like that? What kind of conversations are you having?
We're a victim of it just like everybody else, and we don't have much control. The one thing I will tell you, though, is finding a good insurance agent to help you explore ways to adjust your policy to do a few things. We had one client come to us about co-insurance, and we helped work with them on waiving co-insurance inside of the policy to allow for a lower wind and hail coverage because of the co-insurance wouldn't kick in, so we weren't worried that if they had a $3 million claim, they end up with $1.5 million payment. Those are the kind of things that are really nuanced inside of big commercial loan policies, that are big commercial policies, that when you have someone who really knows how it works and can advise both the bank and the borrower around that, you can end up finding ways to get to a solution in the situation that might work for everybody.
And so find a good insurance agent, broker, whatever, who's well-versed with it. Start having the conversations, bring them into the bank and talk. Does that help address?
The biggest challenge is that there's such a limited amount of market that there's not a lot of people writing, and so you just don't have that opportunity for competition to drive costs down.
Are y'all seeing that? We just don't have a lot of people writing insurance. I don't know what the banks can do, but I believe our next session, we're going to have a little deeper dive into insurance issues.
So one thing I do want to talk about is, remember, we want our collateral to be secured and covered, because we're in the risk business, and I think we want our clients to be in the same position. We don't think that they should take an inordinate amount of risk, that if their building was destroyed, then they'd still have to pay the loan. That really is not a good situation for anybody. We're trying to protect our borrowers and our clients just as much as we're trying to protect ourselves in this situation. So if you find that the bank is very stubborn about how they want certain things, it's for your benefit and ours.
It really is. The things that they're asking of the owners and the developers out there really isn't anything that the owners and developers shouldn't want for themselves. The big difference is the owners, the developers participate in the upside and they don't. So they can't endure the same level of risk that the investors can. I think there was a question up there. I think that's a great idea. What the lenders are looking for is a source of funding to replace or repair their collateral, which is their secondary source of repayment. So I think if there is some creative way that a borrower could propose, hey, what about this? I bet they would listen to it.
So Brian, what I'm hearing is a suggestion that you provide self-insurance for wind and hail. That's kind of what I got out of that question, okay?
Are you saying pretty much full-on self-insurance or just some kind of a sinking fund while you're trying to find something else?
So my analysis of that situation is you're asking for a fight. If you do have a claim, you're asking for a lawsuit between you and the insurance company to decide how the claim was created.
I think it's a question more than anything
else. Well, I know
else.
it is, but what I'm getting at is I'm trying to kind of tell you how we would think about it and why we would say, nah, that's not really a good idea either for you or for us. Look, I understand the costs are exorbitant and are very difficult to overcome. I get that. But when you talk about the alternative of what could happen and the position you're putting yourself in as an owner is so much worse.
Yeah.
And it's a very difficult situation, and it's not that the banks don't want to work with you and kind of figure it out, but when you start to really kind of go through the whole thought process of what could happen and how it might happen, it's a really bad outcome, unless you are super rich.
So
Yeah, and that's why I would dovetail on that. And I think, let's say 9.5 times out of 10, I think what John held true, but one of the nuances commercial, no deal's built exactly the same. So I'd ask around. I mean, it's odd that the regs there's a lot of latitude they actually give banks on how we approach insurance that's not flood. Flood's sacrosanct, and it's the bane of every lender's existence. But when it comes to other facets of insurance, I'm sure we all approach insurance a little differently, especially in the commercial space. Now, residential's a different animal. But yeah.
I think your advice is good. You should ask, and you should talk about it.
Yeah.
But when you get pushback, I want you to and ask them to explain it to you. Ask them to tell you exactly why they think the way they think and how they've come to that conclusion.
And ask with lead time.
So what I was hearing is that you're talking about kind of two different sorts of insurance. One is to replace something that's destroyed, and the second level of insurance is to fix something that breaks. What I'm hearing is zero flexibility on the insurance to replace something. And is that fair? Zero
I
flexibility
wouldn't
on
say zero, but it'd have to be a really interesting circumstance.
zero. And let's talk about the kind of coverage that, you know, can I self-insure or can I raise my deductible way up or something? I think we're going to have to do that. I sense that, and we'll hear about that in the next presentation, I believe, on the insurance issue. There's going to have to be an all-hands-on-deck state and federal response to this to somehow reinsure some folks and support some programs. Real estate is economic development, and if we're not doing real estate, we're not enjoying economic development. So there's going to have to be something going on there. I see that we have about 10 minutes left. Do we have another question that somebody wants? Yes? Okay. Can someone about halfway, I'm so sorry, I can't hear. What'd she say? Gotcha. Have you guys heard? Because we need the insurance for our purposes. It's kind of like title insurance. You need title insurance for your purposes, and they need it for theirs.
So we're in the banking business, not the insurance business. I think leave the experts to the experts. And so while I could change the question around a little bit and say, would we be interested in financing insurance premiums? Allow you to pay them over time. There are companies that do that. So I think you have an opportunity to maybe spread the cash flow out over a longer period of time than having to make a very large payment in a single payment. So there is that. We do have forced placed insurance, which is if you can't get insurance, you can't keep insurance, we will insure the property at a very high cost. And
Through an insurance company.
Through an insurance company.
Sure.
But remember that insurance is covering us only. It does not cover the owner. So if there is a problem, if there's a claim, they're going to pay us, we're going to pay our loan down, and you get no money.
Okay. Well,
Those of us on the stage are already in a pretty highly regulated environment. There's a completely different world that regulates insurance companies as well. So the funny thing is, eternally banks go in and out of this interest of, to your point, one to own insurance companies. It would not be foreign there are a number of banks in this country that own large insurance arms, but it's just a different environment. So I think a bank has to really want to be in the insurance space, independent of the issues that we're seeing now, to make that effort to sort of make it part of this ancillary business and the suite of services that we offer our clients. I think given the challenges here, I don't know if any of our banks are super interested in getting into the insurance business at this stage of the game. So to John's point, leaving it to those that are already regulated and experts in the space.
I'm not sure that was exactly your question. Was your question, why don't banks also become insurance companies? Or are you saying, given that insurance is such a big issue for borrowers, can we get creative and do an all hands on deck and try to figure some stuff out? I will tell you that we have a wonderful, wonderful group here in Louisiana, the Louisiana Bankers Association, and I promise you they're on it trying to figure it out. We're not going to have the banks become insurance agencies, but the banks do understand the existential threat to loans if you guys can't get insurance. It's just a hard thing right now, but we need all the creativity that we can get, and I really appreciate your question, and for you saying it louder, where I could hear it very much. I think. Well, I know, but we have 4 minutes and 51 seconds left, so go for it.
So you're asking about home equity loans, home equity lines of credit. Okay.
And we're still offering them. I think
We're in the business.
I think pretty much all the community banks that we work with and compete with are. I can't speak to why Chase isn't.
Well, I think the bigger banks look at risk a little bit differently than we do, and we're in our communities and want to lend in our communities, and they look at risks over big swaths of economic data, and they have some economists tell them you shouldn't be doing that right now, and so they don't do it.
We're in fewer markets, and we're in the South. They're in New York and California, so probably all plays into it.
Yeah.
And she's from way up north in Alexandria.
No,
So,
I'm from here.
oh, well, yeah, but your bank is up there, so. So does that kind of answer your question? Well, I'll tell you, some banks just make corporate decisions. And that's why I think it's good to have a relationship with multiple banks. I really, really do, just in case that happens. I got just a second. What was you're good? All right.
Paul?
Yes, sir, yes, sir.
You talked about transferring risk essentially to the borrower, and that now you would like us to talk to you earlier and often as opposed to late. So here's a suggestion. When you're looking at the loan indicators, when you're doing your stress tests, the one variable that I think could help greatly is the amortization term. Because, I mean, every deal that you're doing right now, given the existing environment, is going to be short. Doesn't matter what the ammo is, you're going to be 3 to 5 years. So why not give the borrower the benefit of a longer amortization so it can create the cash flow opportunity that you're looking for to either hit the debt coverage ratio or to have the NOI that can cover debt?
That's a good point. It is a lever that could be pulled in the renewal process to make sure. But there are other factors that need to be accounted for if that were to be done.
Yeah. Also, I know I didn't get to touch on renewals, and I think that's kind of what we're talking about now. But I want to say this. Obviously, we've been preaching relationships are important to all of us. Relationships are two ways. So, I mean, I think as we're coming up on renewals, your bank wants to help you. We're not trying to create a criticized loan. We're not trying to put undue pressure on new covenant sets, amortization. We want to work with our borrowers. And I'll say this. I think the vast majority of the loans that got originated 5 years ago that are coming up for renewal, if it's stabilized, performing as we underwrote it, there's really not that much of an issue other than your carrying cost of interest and obviously insurance that's outside of our control is going to factor into our debt service coverage. But I don't think you're going to see us do anything unnatural to jeopardize that relationship. So I think that should be the expectation set on 95% of the deals that performed as underwritten. And so let's start with that. But I will say to the ones, Paul, that come up that do have some pain points, that there was a lot of pro forma or as stabilized NOI that didn't materialize, conversations on that earlier, because no one's going to know those data points. We're the laggards. We're getting stuff 45 to 60 to 180 days after most of our borrowers already know it. And we saw this through the 07, 08, 09, the willingness to re-amortize and get creative, do interest only. I have the expectation if we see a recession that's not a soft landing, we're going to have those conversations, and I think the banks are going to work with our borrowers. But again, this is why relationships are so paramount, because again, if it's your first deal with a bank that you've never heard of just because they had a 25 basis point cheaper rate, and all of a sudden, because I worked at a bank that decided to leave this market pretty easily, that they don't want to be in that asset class, then it's going to be tough for those of us that don't have a relationship with you to come in and save the day on these tougher deals. So, I'm sorry.
No, I'm just saying.
No, I think that's a very good point, and telling us bad news early is really important because we then have a chance to help you fix it. If you're telling us late or after it's already happened or down the road, then it makes it very difficult for us to participate in the process of fixing it.
Yeah. And Paul, I would say that some of the levers in there is if I'm coming up to a renewal and I've got lots of equity, that's a pretty easy discussion to have with the lender. What the lender needs is the loan to pay down so we don't have issues. If you come up to a renewal, I think, and you're already underwater or you're at a higher LTV, it's going to be a hard discussion. Doesn't mean that they're not going to do it, because what's the alternative? So yeah, changing from an amortizing to an IO loan for some period of time, I would say that it's on the table for sure, and I think that's a great suggestion. So thanks. I'm so sorry it's zero. I know that the foreclosure rate is way up, and that's not because the banks didn't do what they promised that they would do. It's that other economic situations have happened where prices are higher and other things. Disposable income has gone down, and our borrowers don't have the cash flow to meet their obligations, and that's a problem. But again, I would say that nobody wants to own the real estate. Nobody wants to own the real estate. It isn't loan to own. So yeah, but we got to figure something out. Nobody wants to own this real estate. So I think a big takeaway from this is you don't get paid until the deal closes. And I say that not so that you know it, but so that you know that the lenders know it. And to serve your customers, to become that trusted advisor to your customers, you need to help your customers, I would say, understand the markets, hear what they're saying. What you did with these lenders 18 months ago may be totally different. So go talk to them sooner than later. 6 months from renewal is definitely not too long. Construction, going to be a little difficult right now, but ask, but pre-qualify your leads. Acquisitions of existing properties, yeah, they're open for business. Did I hit all the big parts there?
You did great.
Thank you all very much. Take your quick break and we'll be right back.
It's not surprising, a lot of insurance questions. I don't know if we're the right speaker.